This is Carl Eggers. I'm a senior wealth advisor and partner at Covenant. And joining me is Justin Paul, who is chief investment officer and also a partner at Covenant. And this quarterly economic review has typically been sent out in a written format. And we decided to change the format this quarter, and we're doing it via video with some narration and also some annotations, which we think will make it a little more interactive for you. So, Justin, in this video, we're going to try to answer two main questions. Where are we and where are we going? Those are probably the two biggest questions that we hear most of the time.
Yeah, that's right, Carl. Let's jump right into it with this first slide and take a look at what happened to the gross domestic product, or GDP, of the economy in the first quarter. You know, consumption makes up roughly 70% of the overall output of our economy. And so on the investment committee, we like to say, as goes the consumer, so goes the economy. So in March, the consumer simply stopped spending. Real, and by real, I mean inflation-adjusted consumption, fell by 7.3% in a single month. And it would have been a lot worse, except that as the lockdowns were being put in place, people went out to the store and they bought a lot more groceries and other goods than they would have otherwise bought. What we actually saw in terms of overall GDP decline, you can see on the chart, was a decline of 4.8% on an annualized rate. Now, you have to consider that in both January and February, the economy was actually expanding. So the 4.8% decline was all a result of a contraction in March. And so the actual contraction was well in excess of 4.8%. Now, as you see on the chart in the light blue shaded bar in negative territory, that this is a forecast number, but the economy was essentially in free fall as we're entering into the second quarter. And a lot of forecasts out there right now are looking at a 25 to 40% decline in GDP in the second quarter. And almost all of that is being driven by the consumer. Now, we do think that we're likely at the tail end of this decline. We may be coming out of that decline right now. And so we do expect that there's going to be a bounce in the third quarter. The bounce won't necessarily be as high as the decline was deep, but nevertheless, as after a steep decline like that, it's natural for the economy to come back out of that. So on this next slide, we're taking a look at the labor market here. And the labor market, as the shutdowns were beginning to be put in place and companies were laying off workers, you can see in this chart that highlights the monthly jobs gained versus lost, that there was a steep decline in jobs in the first quarter here. And no, that's not a data error in terms of that steeply declining line on the far right. In fact, the decline is much steeper than what we saw in the Great Financial Crisis. It's not as deep yet, but we think that we're definitely going to get there. And what's interesting about this chart is it probably understates the actual level of unemployment that was in place during the first quarter. State unemployment offices were simply overwhelmed by the number of applications. They couldn't process them fast enough. And so while the data that we're looking at is the official data, it likely understates the true level of unemployment that we saw in the first quarter. Now, on the next slide, we're taking a look at wages. And logically, with a rise in unemployment, you saw a steep decline in income. And you can see on this chart here where we highlight three lines. One is total aggregate wages. The other is a component of that, which is the private sector. And then the third component is the government sector. And what you'll see is that the blue line and the black line, the total and the private aggregate wage growth, tend to track each other pretty tightly. And that's because private sector makes up the preponderance of jobs in the economy. Now, the government sector, you see a slight blip up in the first quarter as they continued to hire into the pandemic and the lockdown. However, we think that number is likely to turn over going forward as well. So with unemployment rising and wages dropping, but here in the United States, let's pull the camera back a little bit and take a look at what's going on globally. On this next slide, we show the Global Services Purchasing Managers Index. And what this is a heat map. Red indicates a contraction in the manufacturing sector. Green indicates an expansion. And the intensity of the color is the intensity of the color indicates how quick the expansion is or how quick the contraction is. And what this chart illustrates is that the manufacturing sector, while by no means booming in 2019, was at least expanding, both in the United States as well as globally. But then when you come to the first quarter of 2020 on the far right of this chart, it's as if somebody pulled an emergency brake in an automobile and the manufacturing sector came to a screeching halt. And this is something that, as this chart indicates, and we also hear anecdotally about manufacturing shutting down really across the globe. As the manufacturing sector, the labor market, the wage growth, they all indicate that we're into a rough patch for the economy here. And that's probably an understatement. In all likelihood, this is going to be the worst economic event of our lives, at least for a short period here. Hopefully, the duration of this economic contraction is going to be relatively limited. So let's take a look at what a recovery might look like. Now, there's a lot of debate out there about what the shape of the recovery will ultimately be. You hear things like a V-shaped recovery, which would be a sharp contraction followed by a sharp expansion, or an L-shaped recovery in which the economy is permanently impaired. This contraction that we're in right now will never get back to the level of output that we had before, which is certainly a dire outcome. A U-shaped recovery would be something on the order of you have a steep decline, the economy flatlines for a period of several months, if not a year, and then ultimately comes out of it very quickly. You could also have a situation like a Nike swoosh, which is what we think is actually going to happen, which is you have a sharp contraction and the economy comes out of it very, very slowly. And we could go into another type of recovery that looks like a backward square root, which is Carl's favorite shape here. But let's turn to the next slide and look at why we think that you're going to have a slow recovery coming out of this economic contraction. On this slide, we show the unemployment rate as of the end of April 30th. And at that point in time, you had roughly 36 million people that were unemployed. 30 million related to COVID, and there were already 6 million prior to the virus hitting the economy. And at that point in time, the unemployment rate was at 50-year lows at 3.5%, and everything was ticking along fine. Now, if we say hypothetically that over the next couple of months that roughly half of the unemployed people find work and go back to their jobs, and that from that point forward, we add jobs at a clip of about 125,000 per month, which would be consistent with a 2.25% type annualized growth rate. You're looking out to 2027, 2028 before we're back at full employment levels. If you think that the growth rate might be slower, about 1.75%, you're past 2030 before we get back to full employment and people are able to spend at the levels that they were before. So our expectation is that full employment is likely not to occur for some time frame between 5 and 10 years out. So let's stop right there on the economy. And Carl, why don't you talk about these next two slides on the markets?
Thanks, Justin. We saw unprecedented volatility in the first quarter of 2020. And what was interesting was as the viruses actually started to come down, the number of cases started to flatline. We heard bending the curve. And once we started to see that in Italy and other countries, and then started happening in the United States, coincidentally or not, we started to see the fear subsiding in the United States as well. And so what you see is in red, the volatility index, which measures how scared really investors are. And in the blue line is the number of countries that had higher than a 5% growth rate in the number of confirmed cases. So as we started to see the growth rate slow down and COVID really bending the curve, you all of a sudden started to see the volatility come down, and thus the stock market ended up making a low on March 23rd. Now, we knew the first quarter was a really bad first quarter. In fact, the S&P 500 was down exactly 20% from January 1st all the way till March 31st. What's interesting is if you look at this chart, this goes all the way back to 1933 during the Great Depression, and this was one of the worst first quarters that we have seen. The encouraging part about this is that if you look at the rest of the year on every one of these, with the exception of 2001, the market was substantially higher the next three quarters. In fact, the average gain for the rest of the year was over 39%, and the median was over 47%. So far in 2020, it's shaping up to have a recovery. We've already seen that. And we were looking at economic charts earlier. Make sure you understand that there's a very big difference between the shape of the economic recovery and the shape of the stock market recovery. And I think we're seeing that play out, Justin.
No, I agree, Carl. And, that figures into the investment considerations going forward on the next slide. And what we're showing on this slide is the nominal interest rate of the 10-year Treasury in the blue color and the real interest rate, meaning the inflation adjusted, or you take the yield of the 10-year and you subtract out inflation rates over the last 60 years time frame. So what this chart is showing is that interest rates for the last 40 some odd years have been declining. It hasn't been a smooth straight line, but they've definitely come down from their highs in 1981 of close to 16% to close to zero on a nominal basis, and actually less than zero or negative real rates at this point in time. And what people often forget is the implications this has for savings accounts. And so let's look at the next slide to see exactly what that impact is. So on this slide, the light gray bars are showing income generated in a savings account, and while the darker bars are showing income generated in a cash investment account. And the horizontal blue bars, which are probably the most important things to focus on this chart, are the amount of income you need to earn in order to beat inflation. And so, back in the 90s, even through most of the 2000 decade, you were able to beat inflation just by parking your money in a savings account or a money market account, and do so pretty handily. But ever since the financial crisis, when the Federal Reserve began engineering lower rates, that's really hurt savings account interest rates. And I think all of us are aware of this. If you go to a savings account, what you can actually earn on that account is pretty de minimis. And so what that translates into going forward for investors is, in order to make their financial plans work and to stay ahead of inflation, they're going to need to take some sort of risk. The question is, what type of risk should investors be taking? So on this next slide, we show a variety of asset classes and how they've performed each year since 2005. Each color and each block represents a different asset class or sub-asset class. So on here, you have large cap U.S. equities, you have small cap U.S. equities, you have developed market equities, emerging market equities, high yield debt, etc. And it really is difficult to discern any sort of pattern from these squares. Sometimes the worst performing asset class will be the best performing asset class the next year, but other times it'll continue to be the worst performing asset class the following year. So when you're thinking about asset allocation, trying to use a chart like this really has no benefit to you whatsoever. However, there is one pattern that is readily discernible in this chart, and that's the asset allocation portfolio that is depicted in the lighter color or white box. And you'll see in that the asset allocation portfolio never performs as good as the best performing asset class, but importantly, it never performs as poorly as the worst performing asset class. And so if you construct a portfolio that has good diversification, that includes not just large cap U.S. equities and U.S. Treasury bonds, but includes international stocks, other forms of fixed income, you're setting yourself up for a smoother ride and better overall risk-adjusted returns going forward. So to summarize the last couple of slides, with interest rates low and likely to stay low for an extended period of time, portfolio construction is more important than it has been for the last 5 or 10 years. And diversification gives investors the benefit of not having to step out too far on the risk spectrum while also earning a reasonable return on their portfolio. So to summarize, the economy's taken a mighty blow. It is going to recover, but it is going to take longer than I think many people expect at this point in time. And the interest rates pinned near zero require investors to take intelligent risks.
Thanks, Justin. Appreciate that. And just a reminder, we do have a weekly distribution that goes out every Monday afternoon called Covenant U, and it's really our educational piece. It is a compilation of our podcast, our blog, our weekly blog written by Justin, We have financial planning strategies on there, tax planning tips, a lot of good, rich content on there. Real easy to get if you're not currently getting it. All you have to do is text Covenant U to 22828. That's Covenant U to 22828. Justin, appreciate it. Thank you very much.
Looking forward to the next one, Carl.